Well, good morning, afternoon, evening, or even night. These are welcome words that would have seemed unreal just a few months ago and are nowadays sadly all too common for all of us. I sincerely hope that all of you and your beloved ones are safe and healthy. My name is Victor Perez, and I am the partner that looks after EY's Global Integrated Gas Practice. I would have loved to be with you in person today in the great Singapore, a city I love. Although I must say that Petroleum Economists has done a phenomenal job in putting this event together. And actually, they've taught us all possibilities to connect in many more ways than we thought possible just a few months ago. So thank you all for being there. And I would like also to thank our partners, ExxonMobil and Watson, Fairley, and Williams in this great series of events. EY is the event's knowledge partner, and the subject of my words to you today is no other than Asia's critical role in the global LNG dynamics. And critical it is indeed, and will be even more so in the foreseeable future. There are three simple messages that I will address in my speech to all of you today. The first one is that LNG determines, as we all know, the marginal gas pricing in many macro-regional markets across the world. And since Asia consumes 70% of the world's global LNG demand, Asia's impact in the global LNG dynamics is overrepresented. The Asian demand, second message, is going to be served through an increasing number of origins, which together with global dynamics will fundamentally change the traditional Asian price formation and gas contractual dynamics. And the third message is that as a result of all of this, key players are already preparing with new value chain and geographical footprints, but also as well as decisions and investments shaping up the trading and commercial operating model. So if we get into the first point, how Asia is the critical macro-regional market for global gas and LNG, and it will be the epicenter of the world gas and LNG market dynamics in the next few years, we need to look at a few facts. And I won't bore you with a lot of facts, but just a few of them. Countries in Asia Pacific currently consume 20% of the world's natural gas demand. That is far less than the weight of these same countries in the world's LNG demand, which is 70%. As we all know, LNG determines the marginal pricing in many regions across the world. This overweight of Asia in the global LNG market is only going to grow in the next few years, as Asia is expected to account for roughly half of the incremental demand between today and 2040. And this demand's forecast might still have a lot of upside, since Asia is the only region in the world that is expected to present growth in coal demand. If that doesn't happen, and we all know that might be the case, and certainly actions will be taken if the world has any hope of achieving its climate change goals, and then half of the open gap, only half, is made up for gas, Asian demand will be almost 30% higher in 2040 than the current consensus-based scenario. It is true that COVID will delay growth statistics for a few years or even just a few months, but the mid and long-term view does not change. And in fact, we do believe that the balance in the market can actually come faster than it was expected pre-COVID. The LNG fundamentals regarding demand are very strong. The push to reduce carbon emissions quickly and the relative ease of integrating gas-fired and renewable generation assets into power systems will boost demand substantially in the near term, and especially in some key countries in the region. Oversupply was already affecting market dynamics before COVID-19. We knew then that LNG buyers weren't willing to commit to long-term contracts at prices that were acceptable to project developers. Therefore, new LNG was increasingly coming at market at spot prices and financed through balance sheets. It had become, in many ways, not only in Asia, but also globally, clearly a buyer's market. But COVID-19 has impacted demand across the globe, and especially in LNG, as the marginal supply taking most of the hit. Cargoes were cancelled, force majeure declarations were rampant. Suppliers were left scrambling to find new homes for LNG or reduce output. Operational and commercial flexibility were at a premium. Just as an example, natural gas demand in Europe in just 1 month, April 2020 compared to 2019, decreased by over 40 BCMs or 25%. This has had an impact and in a significant delay in new LNG capacity coming online. Originally, nearly 100 million tons per annum of LNG capacity was expected to come online by 2023. And we know now that most of that has been deferred at least by 1 or 2 years to 2024 or 2025. With new LNG supplies delayed by the pandemic, and of course, depending on the speed of demand recovery in the different markets and regions, it might no longer remain a buyer's market for a very long time. Relative to expectations at the start of the year, when we knew or thought we knew that LNG markets would remain well supplied through 2025, with proposed projects at the level of almost 185 million tons per annum in the pipeline, the market might now move back into balance much earlier than that. So the first point is that Asia is going to be overrepresenting the impact and the weight in global LNG dynamics, and that growth is guaranteed, even coming back to balance in the pre-existing oversupply situation faster than we expected. So the second point and big question is where all this gas to Asia will come from, how it will be priced and contracted, and will this change the traditional Asian price formation and gas contractual dynamics? And the question is yes, because as we sit here today, everybody at home or in their own offices looking at their screens, the biggest source of LNG for Asia, or Asia Pacific, it's still Asia Pacific. However, we all know that new sources and origins will merge with the existing supply base with very different price structures, indexations, and arbitrage alternatives. So far, Australia supplies 30% of Asia's LNG demand, and the entirety of Australian LNG exports go to Asia. These exports have grown dramatically at 16% per year over the last 10 years, although they might slow down moving forward, as we all know. And we all know as well that there are not many sizable alternatives for Australian gas beyond APAC. Qatar is the second largest supplier to Asia and definitely the biggest non-APAC supplier. It's the world's largest LNG producer, and their output has grown at 10% from 2009 to 2018. We all know that the biggest LNG liquefaction project on the drawing board by far is in Qatar. Because of geography, however, or thanks to geography for Qatar, their customer base is relatively diverse. And Asian LNG buyers will always face competition from European buyers, thus Qatar always been to arbitrate and using arbitrage opportunities between the Atlantic and Pacific basin spreads. These opportunities will continue to be there, but in a different way, as we will see later. North America, including the US, Canada, and Mexico, it's an obvious candidate for Asian gas to come from. The gas feedstock is plentiful and cheap. The logistics from the West Coast to APAC are relatively easy. However, permitting, regulation, and infrastructure are pending issues to solve. We know how difficult it's been for LNG operators to secure permits to build gas pipelines from Alberta to British Columbia. And we all know that investors' expectations are now being reset, and it's becoming increasingly wary for investors to make commitments to Canadian LNG. The US remains the global growth epicenter for LNG supplies, and it has rocked the gas world dramatically in the last few years. Production grew almost 40% a year from the year 2009 to 2018. The US has still a relatively small share of the Asian market, but that could change. Exports to Europe are always going to face competition or balance from Russian pipeline gas, and off-takers of US LNG could turn to and leverage the arbitrage opportunities more and more that will emerge with developing Asian markets. Within the US, we know that government regulation tends to be light touch, and although that hangs in the balance of the forthcoming elections, the feedstock markets are highly liquid and accessible. Drilling and completion costs are already low, and the potential for further cost reductions driven by digitalization largely is still high. There is no sign of stress on the resource, and the service infrastructure is flush with excess capacity. However, almost half of the projects in the US in various stages of development are on the Gulf Coast and very few in the West. And that creates a certain logistic infrastructure issue. So this has been the second point I would like to share with you, how the origins of gas to Asia will shift, creating as well a shift in the price formation dynamics as gas from different origins and price fundamentals will be put together in the same markets and basins. So what this all means and how are players reacting to this is basically transitioning into upgraded operating models. Because making money in this Asian LNG market moving forward will require companies to make sure they drive every bit of value of every molecule that they discover, produce, buy, and sell in an increasingly competitive and complex marketplace, more connected to other markets and basics, but in a different way. Complexity, of course, is an opportunity in commodity markets, but not everyone can handle complexity successfully. And the ability to do so creates distinctive competitive advantage, much more so than it did in the past. In energy markets, there's always an opportunity to work the revenue side by trading molecules and sending them to the place they are most valuable at the time they are most valuable. The issue, although this has been true for many years and decades, the issue is that this process was, up until now, conducted over the lifetime of an asset or a long-term take-or-pay contract, or at least amongst the different price review periods of those contracts. So minimum 3 to 5 years. Now, we're shifting gears not only to months or weeks, but increasingly more real time. That approach requires players to gather and process increasingly granular market intelligence and data in real time, engage in a potentially large number of transactions, multiplying the numbers that they've been used to in the past, and undertaking market positions and risks they were not accustomed to or were even aware of just a few years ago. So doing that safely requires control process into place, having the right people, installing the right information systems, and accurately measuring profits and risks by putting appropriate transfer price mechanisms in place. In other words, establishing a leading practice, gas and LNG trading and commercial operating model. And this is what the leaders in the industry are doing. Most large IOCs, NOCs, aggregators, and global commodity traders are, as we speak, upgrading their operating models significantly because they know that the sources of potential value leakage in a trading process are well known, but they will become more difficult to manage. Excessive risk-taking, errors in pricing and valuation, counterparty credit losses, and inaccurate settlements. These sources of value leakage can be controlled through effective process design and monitoring, and definitely clients are doing so. People are critical for trading processes and will continue to be critical even in a more digital way. Retaining and developing talent and incentives, it's critical success factor. And just hiring new traders won't do. It is very important, but it is not enough. The preferred operating model has to do with a wide and deep organization structure, strong front-end, front-to-back, end-to-end connections between the front, middle, and back office, and risk-managed trading calls for complex specialized skills across all functional areas right from the start. But people, even very competent people, can't do their jobs, and increasingly more moving forward without the right information systems and the use and aid of advanced analytics and digital tools. The IT ecosystem for the trading company is complex and with specific needs, but the leaders are simplifying the architecture and are incorporating layers that allow them to make the best use of digital and analytic platforms in a very efficient way, maximizing efficiency and reducing operating redundancies. Last but not least, if you want to make money, and everybody wants to make money in the gas trading business, it is essential that you know exactly in your operating model how money is made and that all your employees know that and are working toward these goals. And unless you have an airtight mechanism for internal trading and transfer pricing with a corresponding alignment of the incentives of the people, this won't happen. The transfer pricing operating model adopted will determine the flows between economic entities within your group. Consequently, will determine the shape and nature of the intercompany agreements that will be shaped and need to be put in place to govern the relationships between valuation of transactions, allocation of profits, or the same incentives that we mentioned before. Well, I hope these thoughts have been interesting to all of you. And just to summarize, that the Asian gas market is going to have a much more important weight and will be critical for the global gas and LNG dynamics moving forward. Second, that the origins of gas for the market are going to change and merge and change the pricing dynamics and contractual structures in the region. And third, that the complexities involved are actually making the players upgrade their own commercial operating models. So I'm looking forward to hearing the rest of the speakers and the panelists in this fantastic agenda that Petroleum Economist has put together. I remain at your disposal for expanding these thoughts in whichever way you see fit. And thank you very much, and stay safe, all of you.